Hi guys, good afternoon and welcome to MF Corner. I'm Pavitra, with me is Sonal, and today, Sonal, we're going to discuss sector and thematic funds. This space has, at a time when the market is expected to be so flat, it has really picked up, right? So what we've been talking about is that the market will be range bound. It's not expected to do too much on an index level, right? So is this a good time to be looking at these categories? What are the risks that this entails? And what is the outlook on some individual pockets, that is on individual sectors or themes? So we're going to discuss it all. But before that, just quickly, let me take you through the flows have looked like. We saw a very good inflow of nearly 4,000 crores for sector and thematic funds. This is in the month of March. So here you have it, 3,929 crores for the month of March. It is at a 6-month high for this category. In fact, the Feb number was also very good at over 3,850 crores, right? So if you combine what we've seen in February as well as in March, you will see that the total, of the total equity inflows, so the total equity inflows came in at around 35,900 crores. And of this, we had around 7,800 crores just from sector and thematic funds. So around 22% of the total equity inflow in Feb and March came from this space. So it's definitely, something that's becoming hot. Maybe people are looking for opportunities for alpha generation when the market is a little bit dull.
Oh yes, so maybe that's working for them at a time when they are not able to understand where exactly to invest, right? So let's do one thing. Let's take this theme forward, Pavitra, since you have highlighted it, and welcome Nasser Salim, who's the managing partner of Flexi Capital. We'll talk all about sectoral thematic funds today. Nasser, thank you so much for joining us here on CNBC-TV18. Whereas Pavitra was pointing out, 22% is what the flows have been from these thematic funds in the overall equity flows that we've seen. What do you make of the flows seen in sector thematic funds of late? We've seen a big pickup in last 2 months. You expect it to continue?
Good afternoon, Pavitra and Sonal. It's a pleasure to be back with you on your show. So, clearly, I think, obviously, greed is taking over, if I can say so. And obviously, it comes with its own risks. Now, if I just look at the last few quarters, and, you said February, March, if I just take you back to the last 4 or 5 quarters also, you will see that sectoral funds are gaining huge popularity. Especially because if you look at Nifty returns and Sensex returns since October of 2021, when we saw the cycle changing on interest rates globally and in India as well, the returns have been flat. If you look at the index, Sensex and Nifty, they've been predominantly flat. If you see some of the alphas in some of the other regular funds, they've also been near flat or neutral in terms of very muted in terms of returns. So obviously, there is want for better return on your capital. Now, with that comes in certain sectors. Now, during COVID, we saw a peak of the pharmaceutical healthcare pickup. We also saw banking and financial services as a sector which became very popular. We saw banks which were all-time low since 2018, 19, 20, started to show great returns and numbers on their balance sheets as well. So obviously, sectoral themes, thematic funds, tactical calls, what we call satellite portfolios started being discussed. Obviously, it comes in with its own set of risks.
Okay, got that. So these funds definitely picking up in popularity. But Nasser, at a time when we are talking about the market being range bound, like I was mentioning, you perhaps have to look at these spaces, right, in order to see where you can try to generate some amount of alpha. So take us through, do you think that the current setup that we are in is perhaps a very good time to be looking at this space? It is a good time to get into sector funds?
So, Pavitra, yes, and I think it's obviously subject to one's risk ability and risk-adjusted return that they're looking at. But if you see purely in terms of opportunity, if I look at sectors today, we don't need to look at too much of data. I mean, the data itself will tell you enough of what is expected to come over the next few quarters, and therefore kind of realign or align your portfolios on the satellite part, which is, say up to a certain exposure, does warrant some exposure. And I think that's where we see a lot of opportunity coming in between infrastructure, manufacturing and capital goods. Banking and financial services continues to, kind of augur very well in the current scheme of returns, current scheme of things, and obviously autos and ancillary autos and logistics. So I think, I would like to cover each of these broadly. And, in terms of sectorals, obviously the other quick point that I wanted to make, on your show today was on, if you just compare last year, sector growths by market cap, purely by market cap, you will see capital goods, consumer, utilities, automobiles, banks and private banks as well included, cement as well. All of these have been, in terms of market cap, grown between 23% to all the way up to as low as 9%. Now, that's a huge growth by market cap, and thus the opportunity in some of these sectors that I just mentioned.
Okay, so we are talking about a lot of opportunities, and as you said, we'll discuss that in greater detail as well. But do you think investors should also be aware of some of the risks with these sectoral thematic funds? They should at least be aware of what to do or what they're actually dealing with here.
Absolutely. I think, it's easier to kind of just chase greed and returns. I think we should be very, very cognizant of the fact that risk-adjusted returns, and risks are very high in sectoral thematic funds. I think sectoral funds are very, very concentrated bets, which, goes against the entire diversification strategy. The lesser the diversification, the higher risk that you take on your portfolio at a fund level. It is suitable for investors, clearly, who are willing to take high risk, who have prior knowledge and experience in equity and equity-oriented schemes. Well-informed and active investors should seek interest in this, and investors looking to make tactical allocations. Again, I keep talking about satellite and tactical calls because you can't have all your portfolio in some of these thematic funds. It will create a lot of negative correlation, and that is not good for diversification.
Oh, and that's a very important point to highlight, right? That the risks are there. There are many risks associated with this kind of investing. While the potential for return is also high, you are essentially taking a bet on a sector. So you better be at least, moderately well versed with the markets. But Nasser, that said, is sector investing, according to you, in some part about taking a contra bet? So if you want to invest in a sector, do you try and look for a downtrodden one at that point and, avoid the ones where we've already seen a good move? So it is essentially, where valuations have corrected enough or that sector has not been performing for a while. Is it what that's about?
No, absolutely, Pavitra. I think, when you look at the dashboard and if you look at certain sectors, I think clearly you need to put your monies in capital where there is a lower, where the price to earning bands are attractive, the earnings have increased, but the prices have remained stable or haven't gone up much, and therefore there is a cause in case for investing in those. I think some of the sectors, since you mentioned that and you asked that particular question, we can look at certain sectors again. It's a tactical call, so cautious is the word here. But we can look at something like infrastructure, capital goods, and manufacturing. Why I'm saying infrastructure is because today, if you look at, there is strong government impetus on reviving India's investment cycle, which is an ongoing basis. Capital investment remains key focus. Even, you saw in the latest budget, which came up in FY24, there was outlay, which was increased to 33.4%, ahead of the nominal GDP growth of 10.5%, rupees 10 lakh crores. So that's a big number. I think capex to GDP is now pegged at an all-time high of about 3.3%. So, very interesting numbers there. Increase in capex announcements, Pavitra Sonal, are hinting towards a revival investment by private corporates. I mean, the government has been continuing to say that when will the private start coming in? So I think that's a big hint. I think, the other very important point is individuals increase in investments towards real estate, driving new project launches. We saw something recently in the Delhi NCR region, got sold within 72 hours of its launch. These are all points, trigger conditions and points that tell you that infrastructure as a space could be interesting. And one very important thing on infrastructure, again, before I get on to the next sector, is, if you go back, if you look at the timely exposure to do this opportunities historically, delivered significant returns. So, for example, if you go back in between FY 2004 and 2008, this is data which can be shown. Nifty infrastructure, for example, delivered a 59% CAGR return versus a Nifty 50 that time of just 36%. So you saw a huge outperformance between 2004 and 2008. This can kind of repeat again, given where we are in terms of the play.
Okay.
And again, attractive valuations. In S&P BSE India Infrastructure Index currently is trading at a discount relative to the S&P BSE Sensex and its own historic average price to earning multiple. So therefore, infrastructure is something which is a play which is being looked at by a lot of experts today. Okay. And that's a call that we can definitely look at.
Okay, Nasser, we have a whole host. Yes, we have a whole host of questions for you, and we want to know your take on other sectors as well. But we'll slip into a short commercial break, and on the other side, we'll continue this chat. Welcome back. Still tuned into Mutual Fund Corner, and we still have with us Nasser Salim to talk all about sectoral thematic funds. Well, you know, Nasser, we are talking about a lot of funds and which one look good right now and maybe ripe for investment. So the first one that comes to our mind definitely is the IT sector. We've seen so much happening, so much wealth damage in the last couple of days, but mid-cap IT has picked up today. So do you think it's a good time to look at this fund since we've already seen so much damage and huge cuts here?
You know, I'll be very, well, that's an interesting question again. I think on as far as, you know, IT is concerned, you know, we feel that the earnings could be a little muted over the next few quarters. And, you know, it could give you a good fillip, but, you know, considering you need to have a minimum horizon of at least 36 to, you know, 40 months, we feel that because of geopolitical tensions, global interest rates rising, and with earnings which are a little muted, we also see some of the TCS numbers, some of the larger IT firms that we saw, Infosys, for example, in particular as well. I think the numbers were a little muted and as compared to the previous quarters, and we feel that the IT space today, you know, could be a space which is neutral, and while it is become a little attractive in terms of price to earning, but the momentum still will be better in certain other sectors as compared to IT. So therefore, we have a neutral call on the IT as an index.
All right, neutral call on the IT sector. What about banking, right? That's the other one that we have been talking about. So much is said about the asset quality improving, about, you know, we are seeing perhaps the peaking of NIMs in this quarter as well. But how do you look at this space? And do you think that you would advise a banking sector fund right now?
So, Pavitra Sonal, again, I think banking sector, we've been overweight and we've been, you know, very bullish on the sector as a whole. We feel that there's been a lot of reforms that have been done and are expected to also look at in terms of the entire banking and financial services sector. I think one of the key few points if you were to see is that the banking sector has witnessed a rebound in huge credit growth. If you just look at private sector banks have led the way between FY18 to all the way up to FY22. There has been, you know, between private sector, and sort of the PSB, public sector banks, we've seen private sector banks leading the way. If you look at the retail loan books today, they've been key drivers of credit growth, and that will continue for the next few quarters. I think the other very, very important point on banking and financial services is if you look at the gross non-performing assets, they've been on a constant decline from FY 2018 all the way to FY 22. So if I look at just sheer numbers, at the peak of FY 18, when we saw a lot of credit crisis, we saw a lot of banking NPA issues coming up, it was at all-time high of 11.4%. Today, it's dropped to almost sub 6%. So the numbers between for FY22 is 5.9%. So that's again a big shout out. The other very quick one is that on large banks, you know, we track, not to get too technical, but we track something called capital adequacy ratio, which is nothing but capital adequacy, which is, you know, is basically the capital to risk asset weighted ratio of major banks. Now, those have really improved. And if I look at some of those, like some of the larger private sector banks, those have become far more favorable today as what they were between Q1 of FY 2019. So that's again, these are some of the other reasons why we feel. And the other very big one, you know, we keep talking about this, we keep hearing experts talking about this, is financialization of savings. I think the end-to-end digitalization in banking sector continues to surge. You know, there are, and if I just look at the split of financial transactions by volume, and if I were to go back to between 2015, 16 to now, you will see a major jump. I mean, it was something like, you know, 11%. Today, we are at, you know, over 84%. So there is a huge jump of transactions for digitization in banking, and that's going to ensure that the banking sector remains very, very robust and good in terms of earnings. And of course, one very, very important factor which we've all been, you know, been reading about and knowing is that there could be an RBI pivot announcement soon. And when interest rates go up, the net interest margin increases ideally. So for the next few quarters, until interest rates remain high or they've reached a kind of terminal rates, the net interest margin looks far more attractive for banks, and therefore it will reflect very good and augur very well on their balance sheets.
Okay, we take that point. But you know, one of the themes that we've seen play out in India is the manufacturing theme. We're talking about Make in India push. We're talking about reducing imports as much as possible. You think that will still work?
Absolutely. I think, you know, there has been a tailwind, if I can say so, from global environment, and we can raise our flags as high as possible on that. I think the global environment has become more challenging, Pavitra and Sonal, and with companies focusing on diversifying their supply chain, it has provided a huge fillip to India's manufacturing dream. I think if you just look at some of the key advantages in the manufacturing space, if you compare it to Singapore, South Korea, Taiwan, the other Southeast Asian economies, Vietnam, Thailand, Indonesia, India continues to have the lowest labor cost advantage, which can augur well and contribute to the manufacturing in India position the government has taken. The other key announcements, one is of course just trying to aspirationally dream big, but the other big announcements by some of the bigger names, for example, Samsung, Foxconn, Lava, if I can think of some more, Nokia, Flextronics, they've actually committed, Siemens Healthcare, for example, they've committed huge amounts of money, Medicure, a huge amount of money has been committed between $5.6 billion US dollars, all the way up to 0.9 and between FY21 all the way up to 26. So over the next 3 to 4 years, there is going to be a lot of money which is going to start coming in the manufacturing space. And this, of course, augurs again very well with the entire India's consumption engine. We keep talking about this. There is a working age population ratio which is very, very healthy as compared to the other economies around us. Rising working age population coupled with wider scope for penetration will accelerate India's consumption engine. And we also feel that India has larger scope to penetrate in certain white goods consumption with rising income levels. So I don't know, a lot of investors have been talking about this, experts have been talking. The products today, for example, auto, outbound trips, air conditioners, refrigerators, smartphone users, internet users. Today, the penetration levels in terms of manufacturing and consumption is actually very muted. Today, India, for example, auto, the products that are manufactured for auto and its sector is only 4%. If you compare this to China, they're at 15%. If you compare it to the USA, it's 81%. So, for example, if I look at refrigerators, India's contribution is only 18% as of now. 94% comes in from China, 100% comes in from the US of A. So, smartphone, today, we recently saw some great headlines on Apple announcements. I think smartphone users today is 37% in India, China is 54%, US is 83%. So I think the entire consumption engine is going to contribute majorly to this sector.
We're definitely with you on that, and this is a view that we've heard time and time again. But Nasser, we've spoken so much about how to get into these funds, which funds you can perhaps look at right now, but it's equally important to know when to get out of sector funds, right? Because what you're essentially trying to do is guess when the up move is done, and you may see some kind of rotation in the market. That cannot possibly be easy, but tell us, how would you go about this?
So again, very, very simple. I think it's a very simple approach. You need to be engaging with your experts, your advisors, your people whom you consult. I think number one is you should understand the basic concept of price to earning. I think it's very, very important when you're looking at if prices become expensive, you will not want to buy it. When they are cheap with a perspective of growth, you will want to go buy it. So that's a basic fundamental. My humble submission to your viewers is they should track price to earning bands if they are being recommended any particular sector. That's the first one. The second quick one is, it's a very simple disciplined process. Identify cap and call triggers. Speak to your, advisors, your distributors, and tell them, ask them, can we work on certain cap and calls? Cap and calls is very, very simple. You put in 100 rupees. There is a cap. If you go and in absolute sense, you make 10%, can you come out? Then you exit. On the downside, there's a call if it comes down below a certain percentage, say, for example, 5% or 4%, because, as we said to you, thematic and sectoral funds are very, very risky in terms of volatility, right? They move very quickly in terms of shorter periods, and you can start losing principal. So therefore, just fixing cap and call, facilities at the fund level would be a good idea, perhaps. Exit it only if it continues to underperform over the period of over the period of anticipation that you invested in. So, for example, if you put in it for a particular period and you feel, obviously, this is long term, it's not short term at all. But in that period, if the performance is relatively worse as compared to some of the other peers, you can look at exiting because they give sectoral and thematic funds can give very high returns for certain periods of time, Pavitra and Sonal, and can underperform for many, many consecutive years. So that's a very, very big challenge which we kind of be very cautious of. And cut down. The last point is on this is, if I can think of any other, is that cut down exposure on sectoral funds, which have risen sharply in the portfolio as compared to the overall portfolio, so that you cut down your exposures and the diversification remains ideal at a portfolio level.
Okay, Nasser, thank you so much for all your expert opinion on thematic funds, when to enter individual sectors as well. So it was a pleasure speaking with you, and thanks a lot for joining us today. And with that, it's a wrap on this edition of Mutual Fund Corner. But stay tuned for Closing Bell to take you through the last hour of trade.